Hello and welcome to Online Trade Academy Trading Series. My name is Darek Zelek. I'm the Senior Instructor for Online Trade Academy. Today, what I'd like to discuss with you is positive and negative divergence. When I trade, I try to get some help from some tools. I'm not a really huge fan of indicators since they are lagging tools. Those of you that trade for a little while, you already know that indicators, in order to provide us information, really they have to calculate price to basically tell us whether they're overbought or oversold. However, there's one phenomenal use with indicators that I like to look for is divergence. And what is divergence? Let me explain here for you. What do we mean by this? You see, when price is rising, so for example, when price is, let's put it so before rise, let's say price is selling off, and then it starts to turn around. Now, if I apply an indicator here, what we're going to have, whether it's stochastics, whether it's RSI, whether it's CCI, or any of the indicators, MACD, they all will, when they reference price, there's going to come to a point where they start to diverge from price. So what will happen is typically with these low pivot points, what happens is your indicator is also going to get lower and lower to an oversold territory, or at least will provide that oversold indication. There's going to come a point where when I have an oscillator that moves basically from the high and low, and when it travels to these points, okay, what's going to happen is it's going to provide an indication of low and higher low. And what this will do, this will tell us that price, it's no longer cooperating in that weakness environment, so therefore it wants to change. So let's take a look at charts and let me give you some examples how to look for that positive divergence. And again, it's true for most of the indicators, okay? So I am going to use, I actually use a lot of RSI in my trading, but what I'm going to do, I'm going to choose stochastics, just since I know a lot of people actually use stochastics. So right now applying this to a 5-minute chart. Now this is applicable to any time frame. Okay, so let me just zoom in through some charts and let's just find if I have any positive divergence. Say this is what you see on charts. So I'm basically pointing out to the hard right edge. Price is right at this top after a move to the upside, and it provides us basically a push down. Now what if you point your eyes right now where I'm pointing my mouse pointer right here, you will see that the stochastics, it hovers at this oversold area, or just 20 percentile area. However, there's low and higher low, while the price makes low and lower low. So this is suggesting to us that perhaps price is ready to turn around. So when you see something like this, it gives me a much more comfortable setup actually to take a position to the long side. And as you can see, this is the result of that movement as I move the chart to the right. So next time around, when you see or when you use your indicators, instead of just blindly use the overbought and oversold condition, try to look for the positive or negative divergence. Once you spot positive divergence at support level, chances are the trade is going to work out extremely well. Hope that helps. I see you on the next trading series.